Welcome, everyone. My name is Carolyn Mollen, and I'm the CFO at Independent Sector, and I'm really pleased to have you join us today for a webinar about our favorite topic, UBIT, Unrelated Business Income Tax. I'm really pleased to be joined today by Justin Lowe, who's a Senior Manager in Exempt Organizations Tax Practice at Ernst Young, and then Michael Forster, who's the Chief Operating Officer at the Wilson Center. Just to give you a little background on myself, I'm a CPA. I've been at Independent Sector for about 7.5 years. I'm very passionate about accounting and tax issues in the nonprofit sector. I serve on several AICPA committees, and I'm also on the FASB's nonprofit advisory committee with Mike, actually. And so I'm really pleased to be able to be here to share some thoughts on what organizations should be thinking about with the changes to UBIT specifically that happened with the tax reform. So we'll dive in a little bit to what the mechanics are, and then we'll spend some time thinking about what you and your organization should be thinking about and what actions you maybe might want to consider taking as we're sort of all wrestling through how this is going to impact our organization. So I'd love to turn it over before we look at the agenda and dive in to just have Justin and Mike give a little bit of background about themselves, and then we'll dive into the meat of our agenda. I also wanted to flag for you just a few technical notes. You can put questions in the Q&A box in Zoom. And so we'll be looking at questions during, and then we've also saved time at the end to take questions. And we will also be following up with you after the webinar with both a recording and also a survey. So just be looking in your email boxes for that after the webinar. So with that, let me turn to you, Justin, and just give us a little background.
Thanks, Carolyn. It's a pleasure to be with you guys this afternoon. As you mentioned, I am in our exempt organizations tax services practice. So I work full-time providing advice on UBIT, exempt status issues, and a whole host of other tax issues for entities that don't pay tax. So it's a very interesting career path. And in my former, I've been with EY for about 3 years, and then in my former life, I had my career at the IRS in the tax exempt and government entities division, ending up as a technical advisor to the head of that division commissioner, dealing with all sorts of interesting technical issues on exempt areas and the Affordable Care Act.
Oh, thank you. Thank you, Justin. Good afternoon, everyone. It's also a pleasure for me to participate in this. Thank you, Carolyn, for having me join you in this webinar. I'm Mike Forster. I am a certified public accountant as well as a chartered global management accountant, and have the good fortune of serving with Carolyn, as she said, on the FASB's Nonprofit Advisory Committee, but also on the AICPA's National Advisory Council, as well as the Nonprofit Advisory Committee for the conference. It is my pleasure to do this. I've been in the nonprofit sector in the C-suite for well over 20 years now, serving currently as the Chief Operating Officer of the Woodrow Wilson International Center for Scholars. We are an official presidential memorial to the 28th President of the United States, and have the luxury of dealing with public policy issues. So this is near and dear to me as we talk about UBIT and some of the changes that are coming from the most recently passed Tax Act. So I look forward to participating in today's webinar and providing insights where I can.
Thank you, Justin, and thank you, Mike. So now we'll just give you a brief overview of what you can expect in our webinar today. So we'll just give a brief definition of what we're talking about, recognizing that while Mike and I are CPAs and Justin is an expert in this, that not everybody who's listening may be. So I want to make sure that everyone understands what we're talking about. And then we'll talk specifically about what the changes that happened, and so what you should be aware of, and then what you maybe should be thinking about down the line. Then we're going to talk about how that impacts your bottom line. So how's this going to impact your budgets and what do you need to be thinking about? We'll spend a little bit of time then with Mike and I in particular talking about what we're hearing from our colleagues in the sector, what we're thinking about in terms of how this is actually impacting our own organizations, so that you can have some takeaways back to your organization. And then last, we want to be sure we leave you with some action commitments and some things that you can do if this isn't sitting right with you, or if you think, we hope that you will take away from this that there are some things where maybe there are potential opportunities for improvement, and there's ways that you can contribute to that. And then last, as I mentioned, we'll have some time at the end, hopefully, for questions. So with that, what is UBIT? UBIT stands for Unrelated Business Income Tax. And in essence, when I'm talking about this, this is really, as we mentioned earlier, this is like the tax on institutions that are not supposed to be taxed. So really, these are activities that nonprofits enact in or take part in that generate revenue that is not related to the mission of their organization. So in a lot of instances, for most organizations, you're looking at maybe advertising revenue, publication revenue. You might have a store that's selling things. So there are, various components. We own our building, and so rental income. So there are various components of it, and it's really those things that aren't directly related to the core activities of your organization. As we're all aware, there's a pressure on nonprofits to be generating earned income. So a lot of nonprofits have been stepping into this. I've seen over the years, and there's been a sense, and this goes back in the IRS quite some time, to the sense of, is there advantages being taken by trying to funnel activities that maybe are having losses and try to use those to minimize your taxable income. And so this has been a focus of the IRS for a while, and then what happened with tax reform is that they've really focused on some changes to UBIT that could potentially impact a lot of nonprofits and really increase those of us who are having to deal with filing. If you're not familiar with it, the 990T is the tax return that you have to file to show what your unrelated business income is, and then calculate your tax on that. And so it's something that really impacted a subset of nonprofits and now has the potential to impact almost all nonprofits. So it changed how activities are calculated, and it changed what types of activities might be included. And so with that, I want to turn it over to Justin to give us a lot more detail on how this might impact you.
All right, thank you very much. And so we're going to start out by, now we have our, illustrative example of what UBIT is. And because I'm a history nerd, in addition to a tax nerd, for those that aren't familiar with the origin of UBIT, this actually came up from a school in New York that was gifted a macaroni factory, a spaghetti factory, and they were using the profits from that spaghetti factory to fund their educational activities. But the other spaghetti manufacturers thought that was a little bit unfair to be competing with something that didn't pay tax. And so that's the origin of UBIT. Those rules have grown in complexity since then, but that's the general concept. All right, so and maybe teasing a little bit later, we'll get into some other tax policy questions where some of the current changes may or may not be consistent with the policy arguments that have been put forth, but stay tuned for that a little bit later. So moving on to the core of what was happening in tax reform. First, we'll start out with our disclaimer slide because, again, I'm a tax lawyer, so we have to have disclaimers. But then you can read that at your leisure with the replay. But first, let's talk about what happened with tax reform. We'll talk about it as tax reform or maybe TCJA. There are a variety of different names, some longer than others, that people use to refer to the big tax bill that was passed at the end of last year. It went from proposals to enacted law signed by the president in just a couple of months, and that resulted in a lot of uncertainty and a lot of open questions. And that's something that's organizations are feeling now as they're trying to come to grips with this. And one of the key messages that we want to give to you this afternoon is that this uncertainty is a challenge. You may have lots of questions in terms of how you're going to comply with the new UBIT rules and others. But it's also an opportunity because you want to make sure that you understand the different possible interpretations and then communicate with lawmakers and regulators in terms of what the most practical and effective interpretation should be and what's going to be the least burdensome for organizations. So with that, we'll go back to the, yep, there we go, thank you. So with that, what to expect in terms of next steps for guidance. So one of the key activities happening now is that the Joint Committee on Taxation is putting together what's referred to as the Blue Book. The Blue Book is the compilation and description of what the new tax changes are. It's produced by the Joint Committee on Tax, which is a bicameral, bipartisan sort of think tank within Congress. It's not law, and it's not legislative history, technically, but it is useful to refer to when trying to understand what Congress might have had in mind with these provisions. So it takes several months for that to be produced. Hopefully we'll have something on that front this year, but the last major tax reform bill we had, it took quite a while for that blue book to come out in addition. The other key activity that's going on right now is that Treasury and the IRS are drafting the regulations and other guidance that will implement a lot of these rules. There are gaps, and organizations don't know how to comply right now with some of the rules, and that's Treasury and the IRS's job, is to fill in those and give the details. So one that I'll mention, because you mentioned the 990T, Carolyn, the other piece to UBIT is that you do have quarterly payments where you need to pay estimated taxes. And if organizations aren't familiar with these rules, they can be open to penalties and interest for failure to file UBIT. So that's something else to keep in mind. We're all hopeful that the IRS will issue guidance doing some forgiveness for first-year implementation challenges around this. But again, that remains to be seen. The other prong is that Congress is still dealing with some of the unintended implications of the initial law. One example was the so-called grain glitch, where they were trying to put agricultural cooperatives on similar footing to other agricultural entities, but they ended up not achieving that and sort of introducing a disparate treatment. That was fixed through an appropriations bill that was passed earlier this year. It was sort of must-pass legislation, so they were able to attach a fix to that and get it through Congress and to the president. There are a variety of other technical issues with the existing bill, and there's an opportunity to have conversations and try to get those fixed in a similar manner. There's also talk of a larger technical corrections bill. I think Speaker Ryan just mentioned that in a speech that he gave recently. And on top of that, at least on the House side, Chairman Brady of the House Ways and Means Committee is still talking about doing a second tax reform bill that would focus on making some of the individual provisions permanent, but there's also an opportunity for tweaks to the current bill and other new provisions that might come into play. And we'll talk about that a little bit later. So with that, I think I'll pause and see, Mike, Carolyn, anything else that you want to add on this front in terms of the process or questions that you have for me?
I mean, just the one thing as I'm listening to you talk is reminding me that, you know, I've had conversations with my auditor and tax preparer about this and how it would impact us. I was thinking about the quarterly payment piece. And so I'm looking at Mike to say, I'm imagining you've also been having conversations. And so the very first takeaway I would hope that people have from this is to make sure that you're having those conversations, so that if there are things that you need to be doing to sort of mitigate any potential penalties or other things down the road, that you're having those conversations now and figuring out what your plan of attack is as you're figuring out sort of the rest of it. So that point reminded me of that. So that was sort of my first takeaway that I want to be sure everyone who's listening writes down and goes and does after this.
I couldn't agree more, Carolyn. And yes, we are doing the exact same thing, having those conversations. One additional component that I always do, and I encourage everyone to do, is make sure you also have the right members of your team, your colleagues engaged early on. As I like to say, have them in on the takeoff as well as the landing, because the administrative components of this are going to be new. If you have not had to do those estimated quarterly payments and the like, you're dealing with a new administrative procedure that requires paperwork, and there are people within your organization who need to orient themselves to what that looks like. So while you're having those conversations with your service providers on the financial side, make sure that you have your teams engaged as well, the right members of your team.
Point.
Sounds good. And I think we'll be talking a little bit more about process and how to get this implemented a little while.
Implicated. I like that.
Yeah,
I like that.
So speaking of implications, let's talk about some of the specific provisions that are in this tax reform bill. It's obviously a huge bill. There are lots of changes to the business side of things, lots of changes to the individual side of things. But this slide really highlights some of the key areas that may be of interest to tax-exempt organizations. And the general principle behind the bill was to do what's referred to as lowering the rates and broadening the base. So the corporate tax rate dropped down to 21%. That's good for entities that pay a lot of tax. For entities that are tax exempt, you don't benefit from that, but unfortunately, you tend to get caught up in this broaden the base concept, which is a short way of saying subject more income to tax. And that's what you'll see as we go through some of these. So the first one is slightly different, and that is an indirect effect of the tax reform bill. As part of tax reform, individual taxes were changed so that many more people are going to be taking the standard deduction rather than itemizing their deduction. And so that can change or reduce the tax incentives for charitable giving, because if you're not itemizing deductions, you don't get a charitable deduction. I think there are a lot of studies out there saying that this impact will be significant on the tax-exempt sector, but we're not sure how significant. The other challenge is that it's going to vary depending upon your organization. So speaking of getting the right people involved, take a look at your finances and where your sources of funding come from. If you're getting most of your donations from individuals, but it's in $10,000 or $20,000 chunks, they're probably still going to be itemizing anyway, and they'll still have the incentive. If you are getting most of your funds from grants from other organizations, there may be some trickle-down effect, but it's less likely to be concrete. But if you have a bunch of small donations from folks that were itemizing and now are going to be in the standard deduction, that's where you may see the incentive go away, and your development offices, I think we have a few development officers on the line, need to think about emphasizing the stronger mission-based giving for those types of individuals. For folks that are part of exempt organizations, any further thoughts on that charitable giving piece?
Couldn't agree with you more. It is terrifying to think that that particular provision that might disincent what we depend on in this sector is part of that overhaul. And for all of us who get donations in small increments, in addition to some of the larger ones, we're worried about what the ultimate effect will be in behaviors that will, impact our revenue funds.
It makes it really hard for organizations too, particularly fiscal year organizations, right? A calendar year, sorry, because most of the donations really do come in towards the end of the year, so it will be hard to really know until things have happened, which makes it very hard if you're trying to contingency plan and figure out, okay, so my donations might go down, I'm going to have to pay more taxes, and trying to manage all of that adds a level of uncertainty. And so thinking ahead can at least help to plan and to mitigate and to figure out how you might manage for that uncertainty, but it really is going to be a big question mark and a big concern for a lot of organizations.
And one last thought on that. I think you're right, Carolyn. And as a result of that, one of the things I've been engaged in conversations is it's going to be incumbent on us as institutions in this sector, more so now than ever, to make sure we communicate the value proposition to our donor base, why they should continue to support the mission, why they should continue to support our organizations. If that tax incentive was a motivating factor and they don't see the value benefit of it, then that's on us. So we have to double down on our messaging around this.
Exactly.
All right. Speaking of other estimates and financial impact, these next two we're going to talk about in a little bit more detail, but I'll tee them up here. The first is that for organizations that have unrelated business taxable income, that is income from your unrelated business activities, you now need to bucket or silo that income based on each business. And you can't use losses from one business to offset gains from another. So that's the first big UBI provision. And then the second one, which is even more complicated theoretically, is that organizations will now have phantom unrelated business taxable income on the expenses that they pay for certain fringe benefits like transportation benefits, where the workers, the employees, don't have amounts included in income. So those are two new sources of UBTI, and that second one may start generating unrelated business taxable income for many organizations that haven't had to deal with that in the past. There are a couple of other excise taxes that were created. The first is on investment income of certain private colleges and universities that have more than 500 full-time students that are paying tuition and that have more than $500,000 of investment assets per student. And those organizations are basically subjected to this 1.4% tax on their investment income, similar to what private foundations are subject to today and have been subject to for the last 50 years or so. One key takeaway for other organizations, you may not be a private foundation, you may not be a college or university subject to this, but if you have large endowment assets that you are using to generate investment returns, it's possible that a similar provision to this could be applied to other tax-exempt organizations in the future. We'll talk a little bit about other possible changes coming up, but keep this in mind. It's happened to private foundations. It has happened to colleges and universities. It might happen to other types of tax-exempt organizations as well. The next one does apply to tax-exempt entities generally, and this is a tax on compensation paid to your 5 highest paid employees, and that kicks in if they get more than $1 million in compensation, or if they have a severance payment that's worth more than 3 times their sort of average 5-year compensation over the last 5 years. So that's all a problem that we aspire to have, right, is to be able to get $1 million in compensation or to be able to pay that sort of generous compensation to employees. It may not affect you yet, but keep that in mind. It's something that you do need to track, and track what's referred to as your covered employees, regardless of how much they're making, because those things may change in the future, and none of these amounts are indexed for inflation. So if inflation goes up, down the road, eventually we'll all be making over $1 million.
And Justin, once someone's made over $1 million, even if then the next year their compensation goes down, are they then still included in that?
So, and that's a challenging issue for this. It's sort of a two-step analysis. Every year, regardless of how much you're paying your employees, you need to identify your 5 highest compensated employees. And those are referred to as your covered employees, and they get added on a list. Each year you check if there are new 5 highest compensated employees. They get added to the list. No one ever comes off the list. And then each year you check that list of covered employees to see if they made over the $1 million or over the 3 times the severance, and that's what we would be subject to.
And so that's why I didn't want to get us into the weeds, but just wanted to emphasize that even if this doesn't impact you now and you don't think it will impact you, it's still something that you need to be tracking and paying attention to.
Yep. If you have employees, you need to track your covered employees for purposes. We mentioned a little bit about the reduction in business tax rates. There are also changes to the net operating loss rules. If we have time, maybe at the end we can get into those details. But basically, going forward, if you have future operating losses and then gains in another year, you're only going to be able to use 80% of the net operating loss to offset that income. You still have some small amount of income. That doesn't apply if you have operating losses from 2017 or prior. It's only for losses that are generated in the future. There were some changes proposed and then enacted around tax-exempt bonds, and if you do an advance refunding of a tax-exempt bond, that's no longer tax-exempt. There may be more changes on the tax-exempt bond front as well, so stay tuned for that. This next one deals with organizations that have that endowment that I was referencing and that are invested in what we often think of as alternative investments. So investments through partnerships where you may have a general partner or a manager that's getting what's called a carried interest. And there were changes around when that manager can receive capital gain treatment. So you have a little bit of a disconnect between your investment manager's capital gain treatment and your investor's capital gain treatment, and that's something to be aware of. And finally, there were many changes to the international tax rules. Organizations may be exempt from some of those taxes, but it's likely to at least increase your reporting. So they broaden the definition of what's called a controlled foreign corporation, for example. So even if you're not subject to some of the new taxes, you may have additional tax reporting that's required. All right, let's talk briefly about some of the provisions that aren't in the Tax Act, but that might resurface. I think the most likely one for these organizations is that income from the sale or license of a name or logo could be treated as UBTI. We referred to before about some items of income that are per se UBTI. That's one that could become automatic UBTI. It's not right now if it's passive, but it could be in the future. Any other ones on this list, Carolyn or Mike, that jump out at you?
I mean, I think I imagine donor advised funds are going to keep popping up. So that's one that catches my eye. I'm looking at you, Mike.
No, I agree. That's the one that jumped off the page to me. I mean, we're seeing more and more in the way of contributions coming from DAFs. And so with the jury out on the disclosure or what we may have to do as entities receiving that money, I am keeping my eye close on how the rulemaking, plays out and understanding what requirements will ultimately affect us as an enterprise trying to make sure that we stay in compliance around this. I just last week got another donation that came through a DAF.
Yep.
And I see it increasing right now.
Well, and that's one of the things that may be something that happens because of, we talked about the standard deduction increasing as a tax strategy. I'm hearing of a lot of people who are advising folks to put money into donor advised funds so that they can get the tax, they can basically consolidate their tax benefit and then allocate out.
Right.
So I think we've already been seeing DAFs rise, and I think this might contribute to that as well. So I imagine that will then lead to the pressure that's already been existing to get clarity. The other one, obviously, that stands out is political activity, in particular the Johnson Amendment that's being discussed up this week. So this is a fight that continues to happen, and I think is going to continue to be happening. And so that's something that we need to consistently be paying attention to. I don't think it's going to go away anytime soon, and it's a place where nonprofits speaking up about the fact that we want to stay out of politics is going to be important. So those are the two that raised in my mind.
Agreed.
All right, let's dive now into some more in-depth on the UBI provisions. And we're going to start with this fringe benefit concept. The first piece to keep in mind is that this applies to expenses of your organization that were paid or incurred after December 31st of last year, regardless of your organization's tax year. So often fiscal year entities, those who may have a tax year ending on June 30th, have more time to comply with some of these changes. This one, they have less time. So for those of you who are fiscal year entities, be aware of this. For calendar year entities, it's the same rule, but for fiscal, for the last half or part of your year, you may have this tax. All right, what is the tax on? For a little bit of background, the tax reform bill said that now for-profit organizations cannot deduct expenses that they have for qualified transportation, fringe benefits, and certain other athletic facilities that are only available to highly compensated individuals. But we'll talk mostly about transportation fringes because that's the most common application. So Congress said, for-profits can't deduct this anymore, so we will try to create parity by subjecting tax-exempt entities to a tax on that amount. So basically they said, We think for-profits taxable income will go up because they don't get a deduction. We'll make tax-exempt income go up by that same amount by imposing tax on the deduction. So the first step is to take a look and see if you have a benefit provided to an employee as a condition of being an employee, and that has value, and that value is not included in the employee's compensation because it's a qualified fringe benefit. There are a bunch of steps there, but that's the first element of it. You need an employee. Normally, the employees are taxed on their compensation, regardless of whether it's in cash or some other form. But here, they can have that amount excluded if it's for a qualified transportation fringe. That might be metro benefits, it might be employee parking, something like that. It can be something that the employee is paying for, or it could be something that you are just providing to the employee for free. If you have this sort of pre-tax employee transportation fringe benefit, then you look to your expenses in providing that benefit, and you have a tax on those expenses. It can be very challenging to identify those expenses because this is somewhat of a foreign concept, but in general, you look to see how much your bank account is going down or how much in your audited financials you have a expense for these transportation benefits. So that could be if your organization is paying out amounts to the metro system for employees to get loaded on their metro cards. It can also be if you have a parking garage that's in downtown DC or somewhere else that has value, the employees aren't being charged for that value or aren't paying post-tax for that value. And you may have depreciation, interest expense, maintenance, security, those sorts of expenses are the things that could be subject to the tax. So one final point before I turn it over to Carolyn and Mike for their thoughts on this and sort of the challenges they've seen is that there are various state and local requirements that could say you have to provide these sorts of transportation benefits. So some organizations say, all right, I'm not going to provide these pre-tax benefits anymore. That might not be an option for you if you live in certain jurisdictions, DC being one of them. One final point, I guess, is watch closely what the states are doing. Many states also have an unrelated business income tax. Some of them have proposed not implementing this piece into their unrelated business income tax. Most, though, automatically conform to the federal.
Justin, what about churches and other religious organizations who don't have to file a 990 but may have these types of parking garages or offer fringe benefits? Are they now going to have to file 990?
Yes. So if you have an organization that doesn't file a 990, those types of organizations, churches and other entities, always had to file a 990T if they had unrelated business taxable income. Many of them deliberately decided to avoid UBTI so they didn't have to worry about filing, but now you may have that issue forced upon you.
And I know that's one of the issues, Mike, that I'm hearing the most about are small nonprofits who maybe are filing probably not a postcard, but certainly an EZ filing and
Right.
have not had to deal with this before, and now are having to. I'm sitting here thinking, man, even from my pretty knowledgeable perspective, this feels kind of overwhelming. No matter how many times I've sat here and read through it, it still feels that way to me. So thinking about how that is for smaller organizations and making sure that people even know that they need to be doing that.
Hearing the exact same thing. It's the smaller organizations, all resource constrained, historically haven't had to deal with these types of complexities in terms of their business operations and filing requirements that are saying, hey, does this apply? Sounds like it does. We may have reached out to one or two colleagues across the sector. They may have reached out to their tax advisor or preparer who says, you know, it looks like this does apply to you. And there's a degree to which there's some, you know, freaking out about it. And there's a reality to that. I always say there's administrative burdens that come along with things. Some of them are totally unintended, but they have real life consequences. I think the other thing that's in the conversations I've been a party to And this is not as much about the, the multi-step approach that Justin just outlined, but it is about us as attracting talent and recruiting. And what will that do? One of the things that the nonprofit space, where we're mission oriented, has been known for is that we sweeten the pot a little bit when we go after talent. And sometimes it's hard to compete with the commercial sector, who has the ability to oftentimes pay a little bit more. And we had, a nice benefits platform that included things like this, and taking some of the advantages away, or boxing us in as entities where the tax consequence may cause us to revisit our positions on these, may in fact have a downstream impact on how we go about talent recruitment and retention. And so I worry about that, and definitely have been in a number of conversations surrounding the consequential outcome.
The other thing that I'm hearing, and I'm hoping, Justin, you may be able to make sure we have some clarity on, is I'm hearing confusion about what is impacted by this. Sometimes I'm having conversations where I'm hearing people talk about meals, and because there were some changes to those provisions in the corporate tax. And so I'm just wondering if you can just be as explicit as you can about what types of fringe benefits are impacted. Are meals impacted? Gyms? Parking? I think those are the main ones that I'm hearing people ask questions about. So I just want to be sure we're clear to folks listening so that you know, sort of walking away, what to be looking at.
Yep, great question. So there are 3 categories explicitly mentioned in this statute, this new section 512A7. That's qualified transportation fringe benefits, qualified parking, which is basically a subset of that qualified transportation fringe, and then on-premises athletic facility. So those are the 3 categories that could be subject to UBTI under this rule. Then you go to, I like 2-step processes, right? So then you got these 3. Then your next step is, would a for-profit or a taxable entity have amounts that are non-deductible for those fringe benefits? So qualified parking, qualified transportation, those are non-deductible. Expenses for on-premises athletic facilities generally are deductible for a taxable entity, unless they're primarily for the benefit of highly compensated employees. So if you have an on-site gym that's open to anyone, that most likely is not non-deductible for a for-profit entity, so therefore that's not going to give rise to UBTI for a tax season. And there were changes to the deductibility about entertainment expenses. Those are not named in section 512A7, and they would not be subject to this UBTI.
I think we got about 20 minutes left, and I want to be sure we get through all of this, and then if there are any questions. So I think our next piece is to dive into this is the piece that I'm actually the most interested in, which is the separately calculating for each trade or business.
Yeah. So let us dive into the bucketing. So we have this concept that says, previously, like a for-profit entity, a tax-exempt said, all right, this is my total income from unrelated business activities. These are my total expenses related to those, and I pay tax on the net. This new provision, section 512A6, says that for your tax years that start after December 31, 2017, that's your tax year starting after that date, not expenses paid or incurred after that date. So we have a different rule for this within the fringe benefit. It says, for each trade or business, you can only use losses from that trade or business to offset gains from that trade or business. They can't be used to offset other income from other trades or businesses. And we mentioned some of the net operating loss rules. If you have existing net operating losses, you can use those to offset any trade or business income, but losses that are generated in the future are siloed or bucketed to only be used against that trade or business. So organizations are probably going to have a lot more administrative work in determining what their trades or businesses are, and they also may have a larger unrelated business taxable income and then a greater tax if they previously had losses from one business that were offsetting gains from another. And then the key question is going to be, what is a separate trade or business? A common question, so we have, what about advertising or sales of merchandise? What about advertising in one publication versus advertising in another publication? Is that one trade or business or separate? Some of the other common questions are, well, what if I have an investment that's generated unrelated business income? Is that a trade or business, or is it just some passive income? Is that subject to? So there are a lot of questions around this definition. And the definition of trade or business is something that comes up ambiguously in many different parts of the code. And there's a great deal of uncertainty about what definition, or whether there will be a new definition that's applied in this context. So the final point there that I'll make is that if you do have an unpleasant interpretation, there's always the opportunity to conduct business in a separate taxable entity, because conceivably for unrelated businesses, that taxable entity might have a lower tax burden than if you kept it within your tax exempt organization.
And that's an area that I'm hearing now colleagues really seriously thinking about. So I think that is something that we're going to see in the sector are these spinoffs. I
agree 100%. One of the other things that has come up, and I've been party to these conversations in the past, under ASC 740, you're evaluating your tax, positions, certain tax positions anyway, uncertain tax positions. So as nonprofits, you know, by default, you are tax exempt. So by definition, that's a tax position. Mm-hmm. But now we're talking about having to evaluate activities to determine if it's going to create a different tax position that you have to have an affirmative stance on. And so a best practice, and something that I've been recommending in conformance with ASC 740, is that nonprofits as an entity do that anyway on an annual recurring basis. Is that you're looking at, we're talking about potential spinoffs and separate for-profits. Of course, that's, you're making an affirmative tax position when you do that, or a statement relative to a tax position. But what we're talking about is inside of our operations now, and evaluating these different lines of business that we engage in and making those types of determinations. And a best practice is to have have conversations, obviously, with your tax advisors, preparers, and your auditors on an ongoing annual basis. Too, management should be evaluating what they think these particular activities are rendering in the way of tax positions, and make sure you are updating, if you don't have an affirmative ASC 740 letter that you are in agreement with your tax preparers on and your auditors on, that you think about consider implementing one, and that serves as a basis to spearhead that conversation as you're engaging in these types of evaluations about these different activities and lines of business that you're engaged in. And if you're standing up spin-off organizations in particular, some of the thought processes that evolve to let you make that determination and decision. So I just wanted to throw that out there. There was a very spirited conversation recently that I was a party to around ASC 740, particularly related to these provisions of the new Tax Cut and Jobs Act.
And Mike, that's a perfect segue into the next slide, which talks about what you can be doing now. And so I'm glad, as the tax lawyer in the group, I will point out that I put that second to last bullet there about disclosures that you may need in your financial statements and changes to your deferred tax assets, deferred tax liabilities as a result of these new. So in addition to those financial statement impacts, the first step, right, is to understand what the statute says. Watch and follow the news and the regulatory guidance that's coming out. Assess and model the impact for your organizations. So if you're not already taking a look at whether you have qualified transportation fringe benefits and what your expenses are, do that modeling, do those estimates. Do your estimates for your UBTI under the different bucketing assumptions. So assume worst case in terms of a bunch of different businesses, assume best case with one. Take a look at whether you can do different tax planning strategies, whether that's spinning things off, putting something in an LLC, and because in the future you may want to turn it into a regarded taxable corporation, something like that. Take a look, see if you need outside assistance, whether that is from your sector organizations or from tax advisors. Think about what you need to do for your financial statements, and then really participate in the regulatory process and the legislative process so that you can communicate which of those positions is best for your organization while still giving effect to the letter and the spirit of the tax law that we have.
So now, Mike, I'm hoping that we can start by you just giving us really a brief sort of how are you thinking about this at the Wilson Center? You mentioned a little earlier you're thinking about it from your having two types of employees, but I'm wondering how else you're thinking about it, and then if there are other things from your conversations with your colleagues and peers that you think folks should be thinking about.
Great question. You know, Carolyn, we're thinking about it holistically. It's strategic for us. I mean, everything that we try to do through the strategic lens of our operations. You know, I always, and I'll say this, you know, having a policy created for you know, political expedience doesn't always generate the best public policy, and so, but it does actually create an action forcing event, and so for us, the fact that there's a new law, we have no choice but to really understand what we think applies to us, what might impact our considerations for what we're doing strategically from a business standpoint, the types of things we're engaging in, and the other considerations that were in our glide path strategically, including some of the revenue generating activities we were contemplating. Online education was one. We're looking at a few other things surrounding you know, how we do dissemination of information. There might be an online subscriptions-based service. The new tax law is forcing us to revisit some of those considerations and think about what the implications may be, not just from an operational and revenue generation standpoint, but the tax positions that they're going to create and what we might think about in terms of how we stand that up. To Justin's point about spinoffs, whether we would have a separate entity to house what we believe might be a for-profit activity. These are expanded conversations well beyond our regular routine business operation conversations with that strategic lens that we normally have to say, wow, there may be some you know, expense implications and cash flow implications on our business that previously we would not have looked at in the same way. And so that, you know, that's one angle of the conversation that we're having at the Wilson Center, because these are real, you know, we're nonprofit like everyone else. We're looking at what our opportunities are to have sustainable resources to, you know, to implement our mission. And we're all in that same boat. But this creates, as I said, an action forcing event that makes us revisit how do we implement if we do go there.
Right.
It may be cost prohibitive, and we weren't thinking through that same lens when we originally engaged those conversations. So it's causing us to really revisit some of the existing assumptions and deliberations we were having naturally about what we wanted to do as extensions of our operations to be more sustainable and to have a different stream of revenue coming in. And I would say that based on the analyses from a legal standpoint, whether it's a separate entity that's for profit, and what those implications are, it might affect the decision that we otherwise would make. And so, and I'm hearing that as well from others that I've engaged in conversations with around this very topic. I think the totality of the rulemaking that Justin, you know, alluded to in his wonderful assessment of the law is also challenging, because there's still a few things that we're waiting to see exactly how that is going to be implemented to make those determinations. So in some ways, it's caused us to pause a little bit, and so maybe, let's say, slow down our momentum and take account of what it is we're going to be exposed to with whatever decision we make. But we do still want to make sure that we stand up things that make sense for us,
Right.
that we actually do them in a way that administratively works, and that the outcome that we desire, which is more sustainability, is achieved.
Right. So it strikes me too as you're talking that I know we're talking about UBIT now, but this is coming at a time of a lot of change on the finance side of the house for nonprofits. So for anyone who's listening who's not aware, there are financial statement changes that will impact everybody by the time we get to the end of this year. And so this is happening at a time that we're wrestling with those and how do those impact us. And gosh, now we've got this other strategic layer, which, you know, I heard you say presents an opportunity, and I really like that because I every time there's a change, it's easy to think about the negative burdens that it brings, and I certainly spend a lot of time thinking about that. But it's also, as you point out, a great opportunity to really make sure that you're looking strategically about your operations, that you're thinking about how the activities that you're doing are feeding into your mission one way or another,
Right.
and to really make sure that what you're doing is making the most sense for your organization in the current environment that we're operating in.
Right.
And so I think that's an important thing to think about. I know from IS's perspective, I think I mentioned at the beginning, independent sector owns our building.
Right.
And so we have had losses on that from our debt financed rental income that have accrued over years. And so now it's how is this going to impact us? We haven't had to think about paying UBIT, frankly, because
Right.
we've had these carried forward losses, which will sustain us actually for a bit. So when we reached out and started looking and said, okay, how is this going to impact us? Do we need to be paying estimated taxes? We don't this year because we're carrying forward, but we will in the future, right? And so I think part of it is recognizing even if in this moment in time this doesn't impact your organization, it most likely will in the future depending on what actions happen after that. So recognizing that components of this may impact you in the future, even if they're not now. So that strategic forward thinking is really important. And the other takeaway I'd want others to have is sort of the same thing that I think our organizations are doing, is recognizing that if you go back and look at Justin's slides, there are a lot of provisions. There are a lot of niche provisions, right, that impact small buckets and stuff. And so you're never going to get in an overview like this all the details of the things that might impact your organization, which is why I think it really is important for everyone to be having a conversation with your tax preparer or with your attorney or with your auditor, but to make sure that you really understand the full impact. Because there's a lot of nuance, and so those are, I think, So I mean, I think
every Wednesday night.
as we're coming up to the end of the webinar and really want to talk about what your next steps and action items might be, really just recognizing that there's just a lot here, and so having conversations is important. There's a lot of uncertainty. And so we really just want to make sure that we're all thinking through all of these pieces. It's important to acknowledge that we're not just passive players, right? So we all can take action to help shape how this impacts our organizations. And frankly, I think in the end, the government wants to set up things in a way that facilitates our sector to operate effectively. And partly they need to hear our stories and to understand how this impacts them. If we think back to what Justin said at the beginning, how quickly this all came together, well, it's no wonder that there's all of these sort of unintended consequences. And so here's our opportunity to really share our stories and to make sure that the impacts are being heard. And so, pardon me. So in thinking through that, you know, what are the things that you might be thinking of? What are your compliance costs? We've talked a lot about the administrative burden. So how is this going to impact you in terms of the new system structures, other things you're going to have to do in order to do this? So it's not just the actual taxes paying out that's going to impact you, it's also what's your cost to comply. Mike, you talked a lot about the impact thinking about retention and recruitment, and that's huge in the sector when we're talking about benefits, because as you said, we can't pay compensation generally that's equal to that of the private sector, and nonprofits compensate by having all of these fringe benefits. So how is that going to impact it? And then thinking about revenue, we talked about impact of charitable giving and the uncertainty. You've talked about earned income and how you might be looking at your revenue streams is changing. We've talked about, you know, how is all of tax reform going to impact government funding, right? We haven't talked about the appropriation side, and we're not, but there's all these things in the system right now that each organization has a story to tell about how this is impacting you and your ability to do your work and to advance your mission. And those stories are really important.
Couldn't agree more.
And so how can you, this issue, as we've talked about, it impacts wide stretch of the sector, big cross-section of nonprofits. So it's really important that we're talking to each other. And Mike and I have talked a lot about the conversations that we're having with our colleagues. So all of you who are on this webinar now have a little bit more information that I really hope you take and go share, not just with your colleagues in your organizations, but with those who you're working with externally. I think a lot of times we forget, and I have conversations about this often, that a lot of us may work at nonprofits, but we're also involved in our communities. You may serve on boards, you may have neighbors who are serving on boards of PTAs, of athletic clubs, of all of these things. We don't think about how broad the sector is, and this actually could impact all of those organizations, and they we are the ambassadors for that, so make sure you're talking about it.
And your church organizations too, right? I mean, so Carolyn, you brought up that excellent point about church parking lots and that other aspect. So that's another key group of organizations you may be involved with that need to understand and know.
And so staying up to date and staying connected, like we've observed during tax reform last year when we were trying to push for a universal deduction and really fighting to preserve the pieces in the code that are important to the sector, that the most impactful work that we can do is really us reaching out to our networks and pulling our peers together, right? It's not the infrastructure organization, and I'm not speaking as the CFO at independent sector right now. I'm speaking as a member of the nonprofit community who's in the finance realm, who has knowledge that I can share. And so I just ask all of us to be doing that same. And to be staying up to date, join coalitions and associations, make sure that you're signed up to get your alerts from independent sector, and so that you know what's going on, because as you can tell, this is something, it's shifting, it's changing. And so what we talk about today might be different tomorrow. I also wanted to mention that we have a Voices for Good podcast that it was my first time ever being on a podcast, so I highly encourage you to download our Voices for Good podcast if you want to learn a little bit more. It's been the most popular episode of the season. I didn't even realize that. So it might be a helpful tool that you can share as you're talking to people to give them a better understanding of what to expect. So armed with stories about hardships correlated with complying UBIT changes, it's time to educate your policymakers. So what can you do? First, if you haven't already done so, consider submitting comments to the Department of Treasury to help them understand any new questions you have about how to comply with these laws and how to minimize the negative impacts they might have on nonprofits. So do that. You may never have done it before. Now would be an awesome time. Second, educate your members of Congress on the issue and ask them to take action. So you can get members of Congress to put pressure on Treasury to delay implementation of these laws until there are some of these outstanding compliance issues we've talked about have been answered. So that at least buys us some time to think through and really figure out how this impacts our organizations. Nobody could plan for this because it didn't exist when most of us were doing our calendar year 2018 planning, right? And second, you can ask your congressional delegation to co-sponsor or otherwise support legislation that would repeal these provisions. So first, let's try to get a delay, and then let's try to change it, because what we're talking about now doesn't have to impact us in the future. So I think we're out of time. We had one question come in. And the question, maybe really quick, I think that, okay, so the question that came in was, is parking paid on behalf of employees that is reimbursed by the federal grant outside of this discussion? The answer would be no, I think, right?
Right, I think that's the challenge, and it's extremely counterintuitive to this. The tax is on expenses, right? And so you don't have expenses to offset those expenses, nor are you able to offset the expense with revenue. So your key step again is going to be, are you providing something of value to employees that's excluded from their income as a qualified transportation fringe? And if so, what are your expenses paid or incurred with providing that, regardless of whether you are being compensated in some way for those expenses? Now, depending on whose expenses are they is a whole nother debate that we can have at another time.
So as we close, I just have one last question for you, Justin. What kind of clarification can we expect to come out of Treasury, and do we have any sense of when any information might be released?
Well, that's a very challenging question, and my crystal ball is quite cloudy these days, unfortunately. What I will say is that Treasury and the IRS are working on all of these provisions. So it's important to have those conversations regardless of the provision. They have a set of the highest priority elements. The international provisions are typically what's going first. There's some of the other business deduction elements that are coming along, but they have specifically noted the bucketing of UBI as one of their high priority items. So that's what they've at least said publicly is the priority, along with this compensation excise tax for exempts. But I personally am hoping for guidance on that fringe benefit issue, because that's the one where for fiscal years, they've got to file in a couple of months and they need to know what to do.
Well, thank you for that. Thank you, Justin, and thank you, Mike, for joining me today to talk about UBIT. I hope that this has been helpful for folks who've been listening in. As a reminder, we will be sending out an email with a recording of the webinar and also with a survey that we would love for you to give our feedback so that we can make sure we're providing relevant content. And then if you have questions, you can reach out to Independent Sector. We will field those for you. You can reach out to me as well, and we look forward to having a continued conversation. And I really do encourage everyone to take some action when you leave this webinar. Don't just listen and go back and feel overwhelmed, but really have conversations, reach out to your congressperson. Like, there's actions that we can take to make sure that we're set up to be as effective as